And as part of our adoption process, it's as a corporate responsibility, the third level becomes that besides promoting digital financial literacy through this Women as a Change Agent, how can we involve various startups who are using non-smartphone based measures to increase the adaptability with regards to digital modes of payment. So that's something which we are currently working on. Sorry for the extension.
Oh, great. Thanks, Richa. And I think I just heard last week that the smartphone adoption in India has taken off so extremely that actually the data usage now in India is something like 4 times the use in the US per smartphone. It's a really an amazing story, and I think that's really going to change the game as it becomes even more widely adopted and people have access to a device that that has a flexible interface. So great news, especially when you add the Aadhaar identity and the EPI and all these service providers. So it's well underway. So let's move on to Ms. Tricia Kuna-Weaver, VP of PACES Global. And I want to ask you, Tricia, about disruption in the digital payments. We know there's providers like Paytm and Wing, in this region. Google Tez, for example, with their payments. Facebook is now talking about their Libra solution, and then China, has their major WeChat Pay and Alipay. How did these providers come along as disruptors, and where do you think that's going to lead us, in terms of payment systems globally? And then I know you're also working with Gates Foundation on their Level 1 program, and I want to ask about that because I've worked with this in the past, and I think they came out with this program a few years ago for the development sector, because I think they said that, payments is the foundation of financial inclusion. So their Level 1 program had these guiding principles, things like instant, irrevocable payments and low costs and all this. And I'm not sure how that's influenced this sector, because I think we want to know as development professionals how we can promote financial inclusion and interoperable payments that that can serve everyone. And is that program an example of something that's working, and what have you learned from it? Thank you.
Great, thank you, Thomas. So I'll start with the first question on the potential for disruption of these digital payment providers and digital platform providers. So if we define disruption as entering a market and displacing established systems, and in the context of this panel, which is going cashless, right, the challenge that providers really face is overhauling those systems that allow cash to remain king here in Asia and in many other markets globally. And to do this, it requires reaching those who are unserved by the formal financial system, right? Those who don't have an account, or those who do have an account, but it's not accessible digitally, meaning that in order to conduct a transaction, you still have to physically go to a branch, and those accounts are inherently cash-based. Or those who do have an account and it might be accessible digitally, but it's just not used because it's easier to save under the mattress or to make purchases with cash and coins. And so displacing cash requires tackling this inclusion problem. And the overarching theme of this whole forum, right, is the future of inclusive finance. But I think it's important to understand the distinction between objectives of going cashless and objectives of financial inclusion. So understanding how they're distinct, but also how they're very much interrelated. So if we look at the case of China, right, and WeChat Pay and Alipay, they've had a transformational impact in helping China to shift towards a more cashless economy. But China also started from a position where 80% of adults had access to a formal financial institution account. And so these apps could link to those bank accounts. Now in other markets in Asia that have much lower rates of financial inclusion, in the Philippines, for example, only 30% of adults have access to a bank account. In Indonesia, 49% have access to an account. So the challenge is significantly greater. So for providers to be disruptive, the value proposition has to be there to convert from cash to digital. And digital has to feel easier and faster and cheaper than cash. So there really are two elements to that. There's the front end and there's the back end. On the front end, there are many different elements. There's consumer protection and consumer recourse. But one thing that we see in the work that we do is that a lot of it boils down to the user experience. So in the work that we're doing with the Gates Foundation and the World Council for Credit Unions, what we're working to do is to enable credit unions to offer digital payment services to their members. One thing that we continuously emphasize is that digital payments is not a compelling product in and of itself. Nobody wants a digital payment app for the inherent value of the app. What credit union members want is lights on in their home without having to pay a lot for transportation or spend the time going over to the utility collections office to pay that bill. Or they want to be able to receive their loan disbursement without having to travel to the branch. So these user journeys really need to be designed with that in mind. People want a seamless experience, and again, people don't want payments, it's just a necessary step in the process to get what they actually want. And so we're seeing a lot of some of the more successful companies, payment companies, that actually started as companies that are e-commerce or that are selling an actual product or service. So Uber is a very easy example, but in Indonesia, some successful ones are Gojek and Grab in partnership with OVO, a payment services provider there, where they've been able to give people what they want, the transport or their meals delivered, without even having to think about the payments process. Again, so to be disruptive, getting that UX right, that user experience right, makes all of the difference. And on the back end, the rails or the infrastructure on which payments ride, the potential for disruption is significantly magnified with the existence of an interoperable real-time payment system, as our colleagues in Hong Kong and Korea were talking about. And one thing in consistency with the L1P principles, these systems really should be truly open in nature. And so what that means is they should be open to as wide range of digital financial services participants or providers as possible. So not just banks and not just mobile money providers, but considering other types of financial institutions that are in most markets excluded from the national payment system, like microfinance institutions, like cooperatives, because these institutions reach those at the base of the pyramid, and by providing them access to the national payment system, it can have a significant impact on uptake of digital financial services. And also, having a real-time payment system in place provides that infrastructure that allows other products and services to be layered on top. So in the example of Google Pay or Google Tez, right, that actually rides on the UPI layer. So as these platform providers, Google, Facebook, they have the ability to connect millions of users to interoperable real-time payments via a platform like UPI. One thing that we like to use, an analogy that we like to use at Paces Global, is the analogy of the internet. Right? These tech giants, Google, Facebook, Amazon, they didn't have to build their own versions of an internet. And so in that analogy, the internet is akin to an interoperable real-time payment system, that rail, that infrastructure, that then allows products and services to be built on top. And if that's in place, the potential for new market entrants significantly increases. These new market entrants can compete on products and services and not on infrastructure, and allows them to reach the last mile in a way that addresses the financial inclusion challenge and helps to disrupt the use of cash. And on the second question, sorry, I'll do this one really quickly, but it is an important one, on the Level 1 project of the Gates Foundation. So the Gates Foundation, being a philanthropic organization, very interested in ensuring that the poor have access to financial services. They have a very strong focus on digital payments as that pathway to more advanced financial services. And they've launched the Level 1 project, which was designed to address the challenges in establishing payment systems that are inclusive and actually meet the needs of the poor. So it's called Level 1 because level, meaning it's a level playing field between all digital financial services providers, and 1 referring to a single interoperable system that meets the needs of the entire market, including the poor. And there are two main components to the L1P, the Level 1 project. There are the L1P principles, which is a set of guidelines. It's basically principles, a toolkit that is addressed to regulators, to government agencies, to industry actors on how to design payment systems that are inclusive and pro-poor. And at a high level, these principles include the fact that they're open loop. I referred to that earlier, that it's open to a wide range of digital financial services providers, not just your traditional institutions. It supports real-time push payments, right? Real-time, because of that need now, everybody expects payments to be instant. And push payments as opposed to pull payments for security reasons. It would be a system that is governed by the participants. And in this case, participants being the actual, the digital financial services providers that are actually participating in that scheme, in that payment system. So it should be governed by those who are actually using the system. And it should be operated as a utility on a not-for-loss basis, on a cost recovery plus investment basis. And this is based on the fact that for costs to be low and not to be passed on to the customer, the utility itself, that payment system itself, should be as low cost as possible. And finally, it should offer shared services like a centralized directory that would enable the use of aliases for transfer. So instead of using an account number for transferring, you could use a mobile number or an email address. And the second component of the LMP project is Moja Loop. It's recognizing that the cost of technology is often a barrier to adopting real-time payment systems in a market. The foundation has spearheaded the development of an open source solution, which is called Moja Loop, which can be used to power a real-time payment system. And the work that we're doing right now with the World Council for Credit Unions and with the Gates Foundation is using Moja Loop to demonstrate the potential of and the benefits of interoperable real-time payments between credit unions. And eventually the vision is for this to be interoperability between not just credit unions, but also other actors within the national payment system.
Great, thanks Tricia, and thanks to all the panelists for your great insights. And we will now open up to the audience to ask questions. We have mics on both sides if you have a question, and just raise your hand and I can call you out if you have a question. Oh, we have, okay, I forgot we have the app. Okay, so we'll go straight to it. I have to read it. Okay, in some countries there are more than one payment provider. They have their own interests. How do we bridge all these providers and maintain their interests? Okay, who wants to answer that one? Why don't we go to Sam? I think you're working with a lot of developing countries on developing these systems, so if you have an answer to this one.
I think it depends on the type of payment service providers. There are so many market players in the payment market. As Tricia mentioned, in China, Alipay, WeChat Pay is replacing the role of the commercial banks. So I agree, and I accept that Alipay and WeChat Pay has made a great contribution to financial inclusion in China, and thanks to them, China has achieved the financial inclusion in a very rapid speed in a relatively very short time. But from the perspective of financial inclusion, according to the definition of the World Bank, financial inclusion is providing the access to financial services and a variety of services, not only to payment, but also to credit, savings, insurance, something like that. So, what is the next step? So, do they have to dominate everything? So, I think they need some balance. So, I think the number of payment service providers is not so important. The most important factor is the balance. So commercial banks and financial institutes and fintech firms, they compete each other, they cooperate with each other. So the most important thing is that the platform, kind of a playing ground, they compete each other on fair condition. So it's more important. If there are multiple payment providers, they can connect to each other and they can make a good platform together. Everybody can use fairly and they can provide the service to people. It doesn't matter. It's my opinion.
Great. Yeah, I think this is important. You can talk to both Joseph and Sam about their own networks and the cost of the infrastructure that they've built for their own countries or cities is very competitive. And I think this is actually part of the point about the gates at level 1. They're saying that the cost of this infrastructure doesn't have to be a burden, and it actually can provide a level playing field. Let's move on. So the next question is for Joseph, and how do you manage settlement risk from the faster payment system? And this is again going back to, if the new payment systems have to be instantaneous, irrevocable, how do you combine that with low cost? Because the original ACH networks with the longer settlement times allowed for the security, so you didn't have the cost of all these risks to deal with. But when it's instantaneous, then how do you deal with that?
Thank you. I think in terms of settlement risk, there could be two levels that we're looking at, right? One is because from the central bank perspective, these pieces of financial infrastructure connect all the licensed banks and also the licensed e-wallets. Again, these e-wallets or these banks have been always in business for many years anyway, subject to the respective regulations. But in the past, they were doing the normal business through a daily clearing system, a Hong Kong dollars clearing system. But now they use the fast payment system to do the instant fund transfer. So in terms of our understanding of this organization, connectivities, history have always been there. So on an institution to institutional basis, we don't see any issues. But I think the real settlement risk per se is actually more between the customer and the banks, or between the customer and the e-wallet and the e-wallet provider. And because of these, on the regulator level, we don't impose a limit, but my understanding is most of the banks or the e-wallets would impose certain limit on this transfer to a small amount. Some might be talking about 200,000 Hong Kong dollars, which is like 20,000 US dollars only. And that aspect, at least this settlement risk is a bit limited. And moreover, when these customers sign up for their accounts with these banks and SVF, again, because these are all licensed banks and licensed SVF providers. So in terms of the KYC, in terms of other associated risks such as anti-money laundering, such as counter-terrorist financing, all these are in our law, in our ordinance that they need to cope with. So that's why the KYC process has been quite, I would say, comprehensive. And the last thing I would like to mention as well, but more on the pro-business side, is that and a couple of years ago, these banks already started to offer remote account onboarding. So it's not new. It was done a couple of years ago when even conventional banks providing e-banking service could provide that. So in terms of the experience accumulated, in terms of the compliance procedure that have been put in place, and which have been working very well in the last 2 years, have contributed to the confidence in using the fast payment system as well. But again, I think the limits set by these institutions also give them kind of like a safety net and a peace of mind that it won't really impose any so-called systematic risk in terms of the magnitude of the fund flow. Thank you.
Great, and I think there's also this thing about the financial literacy where you have to explain to people, if you're sending an easy payment where you can just put in their mobile number, if you type the wrong number and actually send it to the wrong person, that can be a problem with these instant payments, and there are ways to deal with that. You can ask the other person to send it back, but with the limits, it does limit that. But I think it does create a little bit of a consumer education requirement. But it's not something that's not systemic. But then going to the next question, Oh, there was a systemic, yeah, that they got raised up on the list. So how do we address the systemic risk that comes with these payment networks? So you have in Korea now, it's a national, effectively, platform that handles everything. How do you know that thing isn't got to go down and shut off the whole economy for, for a day? We know in Kenya with the M-Pesa system that's run by a private entity, and it's basically 70% of the public and most of the digital payments. How does the country handle that risk of having one provider, one platform that's such an essential part? And maybe Sam, you could start with that one as you've just rolled it out and you got 7 million transactions on the first day. So what would have happened if it went down instead?
It's a little different, the situation of Korea and the situation is Kenya and PESA is a little different because our system is connected to the central bank system. So we are adopting the rule of PFMI. So we are managing the settlement risk based on the PFMI, such as net debit cap, and there are several tools such as net debit cap and collateral and loss sharing, something like that. So this is very important. So we are keeping and managing the whole risk based on the global standard. So we can cover the risk of just one commercial bank, even though the one commercial bank bankrupt. So it doesn't matter. We have the system of loss sharing system. It doesn't matter. But in other cases, something like M-Pesa, as I told you, Alipay, and I don't think Alipay and WeChat Pay will bankrupt in some day, but in other developing countries, it has a very small number of transactions, and just one monopolistic player when they go bankrupt. As you know, they are usually using the e-wallet system, so-called e-money system. So they are keeping tremendous amount of inside the company. As I know, in China, People's Bank of China, which is Central Bank of China, already started to regulate Alipay and WeChat Pay. They have to keep the whole amount of money on the reserving account controlled by central bank. So I think this is really important system to keep control. When the payment system broken down, it can cause real tragic accident, and it can cause a tremendous amount of economic damages. So I think it's very important.
Great. Thanks, Sam. Let's, Richa, if you can answer the next question about what's the key for increased adoption of digital payment methods?
Yeah, so like I mentioned, the three things, for us, fortunately for us, Sam, you were mentioning about the government, so our regulator has made a significant change. So while having UPI is the biggest move that has happened in India, but three things that are critical in terms of adoption which has happened is, of course, the Prime Minister Financial Inclusion Scheme. So having bank accounts is actually, has helped. And while it takes time, like I mentioned, you need agents for the transaction to happen, but you have like 98% people still have the bank accounts. And the other thing is having a digital identity and the smartphone penetration. There are about 400 million right now because of the sheer numbers. We are looking at maybe about 700 about another 2 years down the line, so or maybe faster. So these three, so I would say JAM, which is the JAM Trinity, Jan Dhan, Aadhaar and mobile, these are three key areas which has helped in adoption of digital modes of payment. But I would still say we, in the rural areas or the tribal areas that we look at, we still have a long way to go. You need continuously digital financial literacy to happen on a regular basis, both with the merchants as well as the rural people. And in fact, I was just having a conversation with somebody on Myanmar, where about largely most of the people have still, it's a cash-based economy. So you don't have to go to an account-based thing. You can, if you have mobile phones, and I think about 70% people have smartphones there. Why don't we look at a solution which is directly, you have a digital identity and then you directly move to a mobile-based solution. So I think that's where the economy can completely leapfrog into the mobile-based solutions. So that's one area for their economy. But yeah, for us, the regulator has played a big role in terms of adoption, and there's continuously change happening. 2 months back, again, a UPI 2.0 has come, which is ensuring that UPI is given to community in vernacular languages. So because India is diverse, each state has a different language. So for adoption to happen, the language piece is also getting incorporated into UPI. And so these are key, areas which is helping in adoption for digital modes of payment. Yeah.
Great, thanks. I just want to cover quickly how can we ensure that platforms will not be used for surveillance. This is a double-edged sword because I think this is the real reason behind cryptocurrencies' success is that they offer an anonymous digital payments solution that you can use on these dark web marketplaces, and you can, thieves can use if they want to hack into a government website, and there is a huge demand for anonymous digital payments. I think the main reason people continue to use cash is it's anonymous, and merchants basically can control what they're reporting in terms of taxation, and it's a real problem. The central banks, there's laws, you can only carry so much cash across borders, and if you have digital payments, there needs to be some kind of government oversight of that. So, but the problem is now, it's not just government, but now every transaction you do online is then used to ad target for you. So you buy something and then you're seeing ads, and who knows who has this data. So it's a real problem. I think people don't get the Apple credit card just came out, and quite successful launch. What's the most important feature of that card is they promise not to sell your data. There's an interest in this. The government doesn't know what to do. Should they protect you from the private sector ad targeting, or do you want to get protected from the government? Nobody knows the answer to this. It's a big issue, and I know Christine Lagarde just did a speech on this. She said central banks should offer digital currency in order to protect the public from the private sector, and